Good afternoon. How are you, Jordan? Okay. So reminders again, in case any are needed. Your mystery project is due day after tomorrow by 5 o'clock. Okay. So I'll send out an email about subject to put in the subject heading. One group has already turned in your project. So if you turn in your project, I have it. I know the one group. Okay. So the subject line, enter no mystery here. But I also send this out as an email. So basically it'll go into the smart mailbox, no mystery here. So try to keep it as one PDF file. What I mean by that is don't send a file with 5 Excel attachments added to it. It's a pain in the neck. And odds are I won't even click on the right attachment. Right? Yep. No. No, because it's my data set. So what could you have done to it, right? So unless you added something special, I have the raw data. So if you say I screened for this, you have to show me what you ended up as your screen sample. But I don't care about the original data, right? So, and if you run any regressions, just give me enough data that I know your regression is statistically significant. So just don't write a regression equation. Make sure you put your t-statistics underneath so I know that the numbers actually can be used. Okay? So that's Friday. Monday is your third quiz. Right? It covers packet 2. That's it. So what we do today will not be on the third quiz. So Monday will be a third quiz. And actually things are speeding up, right? 2 weeks after that is the last class, at which point you have to turn in your final project. And then 2 days after that is the final exam. So the next 3 weeks pretty much everything is going to come at you. And if you've been putting things off, a lot of stuff is going to come at you at the same time. So let's start on real options today. Okay? Loaded word. We're going to talk about how people use it, how I think it's become a distraction in a lot of discussions, and why real options can be so exciting. So today let's start off with a few questions that are going to be a preview of what we're going to talk about today. So let's say that there's a small startup. It's come up with this new cell phone technology that speeds up downloads. So it's completely different, but it's an expensive technology. Implementing this technology today will cost you $2 billion. And if you do the projected cash flows from selling this technology, the present value of the cash flows is $1.5 billion. Let me pause right there. If this were corporate finance and I asked you to do a capital budgeting project, the net present value of this project is going to be minus $500 million, right? Should you implement the technology? The answer is obvious. Of course not. It's a negative net present value right now. Don't implement it. But let's assume I'm looking at this technology from the outside. I'm Samsung or Apple or some smartphone manufacturer or Google for Android. It's a non-viable technology today, and it's non-viable for me as well. Might I be willing to pay a price for this non-viable technology? In other words, you see what I'm saying? With the rule in capital budgeting is negative net present value, it's worthless, right? But might I pay, if you gave me exclusive rights to this non-viable technology, might I be willing to pay a price for it? I heard a yes. No? And why?
Because of the option value.
And
volatility in the future, having exclusive rights may...
and the volatility in what? What do you hope to see happen?
That it becomes a viable technology.
Which means based on what I know today in the market I see today, the value is $1.5 billion, right, to the cash flows. But this is an uncertain business. Who knows? A year from now, it might be the market becomes 10 times larger. The cost of delivering it become 10 times smaller. The $1.5 billion could become 10 billion. We're now one of the most dangerous places in finance, where we're letting hope drive our decisions. But that's the nature of options, right? And could you have regrets 5 years from now if I came and asked you about this investment? Yeah, for the same reason, if you bought an out of the money option, what happens to most out of the money options? They end up in the trash can, but that doesn't mean they're not valuable. And what makes it valuable is you have the rights to this technology and you're ignorant. This is one of those few places where knowing less is actually better than knowing more, right? The more uncertain you feel about the future, the greater the value of the option. Now do you see why real options excite so many people? They reward you for knowing nothing, and they make uncertainty a good thing rather than a bad thing. We'll talk about the limits because you can very quickly see how this can get pushed to abusive points, right? Because after all, this is what people have used for the word strategic for, which is you go invest in China, you're going to lose money, it's okay because, finish the rest. It's a big market. You should do this, you're going to lose money, it's okay because there's a lot of opportunity there. We're going to talk about the line between real options and wandering off into the strategic no man's land, because that line is a critical one. Right? So let's say you decide to buy this non-viable technology. So you've decided you buy it as an option, right? So use what you remember about option pricing to answer these. What will happen to how much you're willing to pay as a function of how many years I give you these rights? Like, as my rights go from 3 to 5 to 10 to 15, the value should go up. And what should happen with uncertainty? Same thing. As my uncertainty increases, you're going to be willing to pay more for this right than less. What I've just said. You pay more for non-viable technologies where you have exclusive rights in a business where there's a lot of uncertainty than in a business with relatively little uncertainty. We're going to use this later to talk about R&D. You see the connection? When a pharmaceutical company or a biotechnology company invests in R&D, what's it getting in return? It's getting a bunch of options, right? That's what you get. You don't get a guaranteed commercial product. You get a bunch of options. And what have we just said? Those options are more valuable when things are uncertain than when they're certain. So if you're a pharmaceutical company trying to decide where your R&D should go, and I give you two choices. You can put your R&D into headache remedies where we know a lot and your cash flows are going to be more precise, or into gene therapy where we know very little and the future is very uncertain. Hey, guess what? We already have an indicator as to where the money is going to go. It's going to go where there's the most uncertainty, because we're now talking about options, and options derive their value from uncertainty. Final question. Let's say you do buy the technology, and let's say you turn out to be right. The technology becomes viable. What I mean by that is the cash flows are now risen 2 years later. They're now greater than the cost of developing the technology. Should you develop the technology? In option terminology, what am I asking? Should you exercise the option? The option has become in the money. And if you use the option pieces we've learned so far, should you exercise an option the minute it becomes an in the money option? What's the trade-off? It's not just time value, it's the option value, right? The minute you exercise an option, it ceases to be an option. You might actually decide to let this technology continue to be an option while you learn more. Maybe you will find a better way to exercise, a better time. And again, that's something we're going to talk about, because that's going to have some very real consequences for you as an individual. And here's why. We're going to talk about a patent as an option. So if you're a pharmaceutical company, what's a patent on? It's on a drug to treat MS. The drug has now become a viable drug. If you have MS, what do you want the pharmaceutical company to do? Develop it instantaneously, right? One of those scenarios where the pharmaceutical company says, no, we're going to wait. We're going to wait because of this, this, and this. The value of the option exceeds it. And we're going to talk about the optimal time to exercise. You're not going to wait till the very last moment, at the very last day, as you do with the listed option. And we're going to talk about how we bring that into the process. So that's what we're going to start on today. It's a very different place to be than what we've talked about with traditional discounted cash flow valuation. But it's actually pretty exciting place because it allows us now to develop a framework which we can use to bring those strategy people into the conversation. So when you say strategic, I'm going to start to put a real options framework on it to see if in fact you're on solid ground or you're just making up stuff as you go along. So let me start off with a statement. I remember about 15 years ago when I started to incorporate real options into my classes, and I thought I should teach them as part of a valuation class. I went on Amazon.com and I looked for books on real options. In the late 90s, there were 2 books on real options. Nobody was talking about real options, nobody was doing them, nobody was using it. Today, if you go into Amazon and type in real options, you're going to see dozens and dozens of books. You walk into most consulting firms, there's real options floating around all over the place. You open up the McKinsey Quarterly, real options here, real options there. CSFB actually started using real options in their equity research reports. And that scares me a little bit. Not CSFB using it, but the fact that real options has now become front and center. Because in finance, we have this very bad habit of stating the obvious, claiming the outrageous, and charging the absurd. Right? And real options have become a way in which consulting firms and equity research reports can explain why you do stupid things. It's taken on the same role. We were talking about weapons of mass distraction, those words that people use because they can't come up with the numbers. So 25 years ago, if you did an acquisition and I said, why did you do it? And you'd say synergy. 15 years ago, you might have said strategic considerations. 10 years ago, you might have said focus. Today, so why did you do that stupid thing? You say, it's a real option. Most people who talk about real options actually never value them. They just use them as an explanation for whatever they've done, which can't be explained by the numbers. And I don't want that to be the case. I think there's a real basis for real options, but it's in a very narrow set of circumstances. So what I hope to give you are the tools so that you can separate the cases where real options really have basis from the cases where they don't. So I'm going to use a very simple example to illustrate where the value of a real option comes from. And I'm going to use essentially a decision tree. So let's say I come to you with an investment. So here you are today. And here's what the potential payoffs are going to look like. If you succeed, so it's like a gamble. If you succeed, you're going to make 100 million. If you fail, you're going to lose 120 million. Would you invest in this? What's the expected value of this investment? Minus 10 million, right? You're saying, that's horrible. I'm going to give you a second choice. You invest today, so there you are. There's a 3/4 chance of success. So I first made this 1-round investment into a 2-round investment. So the first round, if you succeed, there's a 3/4 chance of success, you make 20. If you fail, you lose 20. If you make 20, there's a follow-up round where if you succeed, you make 80, and if you fail, you lose 100. You see, what do the two have in common? Collectively, they share some common characteristics. You look at my total loss, if you add up the minus 120, that's minus 120, which adds up to what I had before. 20 plus 80 is 100. 3/4 times 2/3 is half. So there's a 50% chance cumulatively of success and a 50% chance of failure. So at a very, very generic level, the two draws look similar. 50% chance of success and failure, total gains and total losses work out to be exactly the same. But if you took the expected value of this decision tree, there's a little bit of magic that happens. Remember that minus 10 that I got before? It actually becomes a plus 3 or a plus 4. So I have a question. It's an intuitive question. Why does this 2-stage decision tree give you a positive value when the 1-stage decision tree did not? What is it about this decision tree that makes it more attractive to you as an investor? Deepinder?
Is it because you don't have that second tree coming from both?
And you didn't because you chose not to have it, right? Why did you choose not to have it? Because when you did that first round, you had a bad outcome. What did you learn from this? I'm not going on any further. there are two things that create the value for a real option. One is learning. You're learning as things happen, and then you're adapting your behavior based on what you've learned. You see what I've said? What I mean by adapting your behavior? You don't have two stages no matter what. If you get a bad outcome in the first stage, you stop. That's where the value is coming from. I'll give you, you're saying this is very abstract. When is it going to work out? Let's say you run an oil company. Right? You could argue that when you do a traditional DCF valuation of an oil company, like I did for Lukoil on Tuesday, and I posted on my blog, I am undervaluing the company. Why? How do I get a discounted cash flow valuation? I have expected revenues where I assume that you produce a certain number of barrels of oil, multiply by the price per barrel, you come up with revenues, subtract out costs, you come up with cash flows. That's the way we're supposed to do DCF, right? What am I missing when I do that though? If you run an oil company, are you set on autopilot in terms of how much oil you produce? You have the option not to produce or at least produce less. So if the oil price is $45 a barrel, how much you explore, how much you produce is going to be a lot lower than if it's $110 per barrel. That's the optionality. It's learning from watching the oil price and then adjusting your behavior. You can't be Petrobras, because then you learn from the oil price but you never adjust your behavior. That's the optionality is gone. But if you're a sensible commodity company, that's the optionality we're talking about. So the value of the option comes from those two pieces. So what I'm going to do actually is set up three questions to kind of bring in option pricing into valuation. And you have to answer yes to all three questions before you can start to put real options technology to use. First, I'm going to ask, when should I even be talking about real options? Set up a framework for deciding when the real options piece should even enter the conversation. Second, and this is the critical question, when does that real option have significant economic value? And I'm going to give you the one word that will actually separate the fakes from the real uses of options. Right? And third, when can I use an option pricing model to value that option? So when is there an option? When does that option have significant economic value? When can I use an option pricing model? Along the way, I will call on your memories of the Black-Scholes and the binomial. You're saying, what memories? Never heard of them. I know. So what I'm going to do is give you a 40-minute quick review of all the option pricing you need to know. And it's actually a very simple concept. If you strip away all the algebra and the math there, all the option pricing you need to know to actually use real options in valuation. So let's start the process off. When is there an option in a decision? When should I even be talking about options? You know how you can tell when there's an option? What makes options unique? It's payoff diagrams. And what makes option payoff diagrams unique is that kink they have. That if the underlying asset's value is less than the strike price, if you have a call option, you lose what you paid for the option. And if it's above, dollar for dollar. So if you look at what creates an option, first, options are leeches. You've got to tell me what the underlying asset is. So anytime you talk about real options, I'm going to ask you, what's the underlying asset? If you have no idea what I'm talking about, then you have no idea what you're talking about. Right? If you talk about options, there has to be an underlying asset. With every option that I try to identify, I'm going to tell you this is the underlying asset. Second, there's got to be a contingent payoff. Do you see what I mean by contingent? I've got to say, if this happens, then there's a payoff. If there's no contingency, there can be no option. And third, options have a finite life. In fact, one thing I'm going to do with every option I talk about is I'm going to draw the payoff diagram. And if the payoff diagram I draw for any action looks like this, I have a call option. I can call it whatever I want. Fixed losses, unlimited profits. With a put option, of course, everything gets flipped around. You got fixed losses on the upside. But what makes options unique is that fixed loss on the downside. So the first step in the process is there an option. But remember what you need: underlying asset, contingent payoff. When I wrote the paper on real options, it's on my website still from way back. The title of the paper was "Opportunities Are Not Options," because a lot of people use the two interchangeably. I might have told you the story before. I don't even know what stories I've told you, especially if you've been around 50 sessions with me. But I'll tell it again. It's about second year MBA came to me, end of one of these classes, 4 or 5 years ago. and he was renting his apartment. And he said, my landlord has given me an option to buy my apartment. I'd like to use the Black-Scholes model to value this option. I said, aren't you getting a little carried away? He said, I've spent a lot on the MBA. I want to try it out. So I asked him the question, which is, your landlord has given you the option to buy the apartment. At what price? He thought about it for a moment. He said, you know what? He never mentioned the price. So I said, let me get this straight. Your landlord has given you the right to buy the apartment you're renting at whatever the prevailing market price is anytime over the next year. Is that right? And he said, yeah, I guess that's right. And I said, what do you think that's worth? The right to buy your apartment at the prevailing market price. Anybody on the street has it. There is no exclusivity here. This isn't an option. So make sure that there is that contingency. Because if the landlord had added, you can buy the apartment at a 500,000, a million, $1.5 million, then we can talk option pricing. But you need that contingency to be specified up front. So that's the first step. Second step in the process, I've already laid the foundation for. You're going to run into lots of options in lots of investment opportunities. You're a VC, option here, option there. But here's what you need to focus on. There's no point doing all of this stuff with an option if it does not have significant economic value. Right? Otherwise, you're working on. And the word that I used before, exclusivity, is what separates significant economic value from not economic value. I'll give you one of the examples I gave in lay the foundations. We never use the metric. I talk about Marriott opening 10 hotels in China. And let's keep this completely stark. Let's assume Marriott knows on an expected basis it will lose $15 million. So the net present value it's computed is minus $15 million for these 10 hotels. But it decides to open the 10 hotels anyway, and here's why. If those 10 hotels do really well, Chinese just love Marriott's. The free breakfast, whatever they serve at 6 o'clock in the evening. People are just coming and you can't keep them out. Here's what Marriott plans to do. It plans to expand into the rest of China and open hundreds of hotels. See the option argument? We're going to open the first 10 hotels. We know we're going to lose money on an expected basis, but we're okay because we get the option to expand, a real option. What's the weakness in that argument?
Why do they have to open the first 10 hotels in the first place?
Well, they don't know anything about the Chinese market. It's the fact that they don't know the market. I'm sorry?
Open one.
Well, we can use the same argument with one. It just makes the scale a little, it's a smaller option, but you still have to open. So with the one hotel, why are you opening that? No, how would you, it's still a weak argument even with one hotel. So the question is, what's wrong? Yes?
Unless there's some exclusivity tied to those leases for the next group of hotels and other chains.
In other words, while you're watching, Marriott's watching these hotels to see how many people are checking in, how many, hopefully the same number are checking out. Who else is watching those hotels? Hyatt and Holiday Inn. So while you're accumulating this information, and just as you get ready to launch in the rest of China, what do? They beat you to it. In other words, they let you do the dirty work of the research and they jump in. There's no exclusivity. You're saying, what would make this an option? What if Marriott approaches the Chinese government and the Chinese government gives them this license that says, if you open these 10 hotels, you and only you can open these 100 more hotels. Then we've got some exclusivity. And that's where I think a lot of this real options cheap talk breaks down, is the next time somebody talks about an option, and people throw real options onto the table all the time, ask them that exclusivity question. What is it that gives you exclusivity? Because without that exclusivity, the value breaks down. So when is there an option? Look for the payoff diagram. When does that option have significant economic value? Tested on exclusivity. Third step, you get ready to apply an option pricing model. Okay? And if you think about the value of an option, we know what those determinants are. We've known for 40 years, there's no debate about the fact that the value of an option rests on 6 variables. Here are the first 3. They relate to the underlying asset. First, as the value of the underlying asset goes up and down, the value of an option will also go up and down. That right to buy your apartment will increase if real estate prices are going up. and it will decrease if prices. So the first is the value of the underlying asset. Second is the greater the uncertainty about that value, the more valuable options become. And the reason is simple. Risk is a bad thing in discounted cash flow valuation. Risk is a bad thing in relative valuation, but risk is a good thing with options because I've limited your losses, that finite loss there. So the greater the variance in the underlying asset's value, the more valuable all options, calls and puts become. Third, if there are any dividends expected on the underlying asset, that will reduce the value of call options and increase the value of put options. Why is that? Why would dividends on the underlying asset affect call options and put options? Let's make it a stock, and you own a call option on a stock. What happens on the ex-dividend date to a stock? It's going to drop by roughly the amount of the dividend. So holding all else constant, if you have a call option, let's say it's a 6-month call option on Con Ed, and you know there are 2 quarterly dividends that are going to come, 1 in 2 months and 1 in 5 months, this is not unpredictable. You know on those days you're going to lose about $1.50 or $2 in stock price. I think Con Ed dividends right now are about $4 per share, about $2 is stock price, which means call options will become less valuable and put options will become more valuable. This morning's class in corporate finance was about why companies buy back their stock rather than pay dividends. And one possible reason is if you reward managers with options, guess what? You've already built in a system that says don't pay dividends because on the ex-dividend day the price will go down. Buy back stock instead. So underlying assets value, the variance in that value dividends. There are 2 variables relating to the option. The strike price matters. Obviously the right to buy your apartment at $500,000 is worth a lot more than the right to buy the same apartment at $1 million. And second, the more time I give you to play this game, the more valuable all options become. The only macro variable that drives the value of an option is the level of interest rates. And here's why. You get the right to buy my apartment for $500,000 in a year, right? The present value of that $500,000 is going to be a function of what interest rates are. The higher interest rates become, the lower that so if I'm in a 30% interest rate environment, buying your apartment at $500,000 actually costs me less than if I'm in a 3% environment. So call options become more valuable as interest rates go up, and put options become less valuable because in a put option you're going to get $500,000 or $1 million a year from now. The present value gets lower. Yes.
Isn't assuming you pay cash, so
Cash for what? Doesn't matter, right? No matter what you do, if you use something as a substitute for cash, you still have a time value effect.
yeah, but if you're paying 30% interest on a mortgage that you used to buy that apartment, if rates go from 6 to 30%.
Well, but that's the underlying assets value. So clearly, if you hold everything else constant, interest rates matter, but everything else is not held constant, right? So if interest rates go up, your value might change, your variance might change. But holding all else constant, the level of rates can affect your options. That's it. Those are the 6 variables. Now let's do some option pricing 101. Okay? For those of you who are taking option pricing, I apologize in advance. It will be too trivial for you. For those of you who remember your option pricing from foundations, I still apologize. For those of you who have no idea what option pricing is, I apologize in advance for putting you through this process one more time. Well, you've been trying to ignore it, obviously, for most of your MBA life, okay, or your undergraduate life. The driving force in all option pricing models is the notion of a replicating portfolio. Let me give you some history. Prior to 1971, the way people valued options was the way they valued any other asset. They have expected cash flows, they'd project out the cash flows, they adjust for probabilities, they take the present value. So they valued the option just like they value a stock or a bond. What Fisher, Black, and Marr and Scholes did that was revolutionary, they said, look, I can create something that looks exactly like the option in terms of cash flows by using the underlying asset and either borrowing or lending. That's it. That's the insight you need to understand option pricing. Is they created what they call a replicating portfolio. We'll go through the mechanics of doing it. It's not complicated. But if you create that replicating portfolio, which has exactly the same cash flows as the option, they drew on a second principle, the principle of arbitrage. Which is if you have 2 investments with the same cash flows, the replicating portfolio and the option, what does arbitrage require? That they have to trade at the same price. That's it. Every option pricing model, that's all you do. You create the replicating portfolio, you see how much it will cost you to create that replicating portfolio, and then you say the option has to trade at that same value, because if it didn't, you have a costless riskless way of making money. Just buy the cheaper one, sell the more expensive one, and keep the difference. And the cash flows will offset each other. So every option pricing model is really the search for that replicating portfolio. And if you want to really understand this replicating portfolio, basically this is what the replicating portfolio will look like. If you're trying to replicate a call, you will have to borrow money and buy a certain number of units. My delta somehow became D's. Let's call them delta. So a certain number of shares of the underlying stock. And we'll talk about how much you need to borrow and how many shares to buy. But you can create something that looks exactly like a call. It's called a synthetic call by borrowing money and buying the underlying asset. If you have a put, you're going to sell the underlying asset, sell short the underlying asset and lend the money. So the entire game becomes, can I figure out what that replicating portfolio is going to look like? The Black-Scholes came first. But it's actually messy to actually see the replicating portfolio in there. But we'll come to it. I'm going to use a simpler model to show you the replicating portfolio. It's called the binomial model. Sounds fancy, but in the binomial model, the stock can jump to only one of 2 points. In fact, let's assume you have a stock that's trading at 50 today. It can jump to either 70 or 35, hence the word binomial, only 2 points at each point. You'll see why it has to be only 2 points. If it goes to 70, it can jump to 100 or 50. If it goes to 35, it can jump to 50 or 25. So that's the underlying stock. And at t equal to 2, the stock can be 25, 50, or 100. I come to you with a call option with a strike price of 40, which is going to expire at t equal to 2. And I say, I want to know how much I should pay for the option. Let's start simple. The stock price today is what? 50. The strike price is 40. So at the minimum, this option should have a value of 10. The exercise value is 10, but you know it could be worth more because there's optionality. So here's how I'm going to price this option. I'm going to start at t equal to 2. You're saying why? Because that's the only point in time where I know the cash flow with almost guaranteed, right? At t equal to 2, if the stock ends up at 100, and you have so you be the person with the call option of 40. Stock ends up at 100. What are you going to do? You're going to exercise the option, pay me $40, get the stock, and turn around and sell it at 100. Your profit's going to be $60. If the stock goes to 50, you buy it at 40, you turn around and sell it at 50, you make 10. Stock goes to 25, you buy it at 40, you sell it at 25, you lose 15. I hope you do that, but because you don't have to, that's the nature of an option. Stock goes to 25, what do? You take the option, put it in the trash can, and your cash flow is 0. So at expiration, that's what the call cash flows are, 60, 10, and 0. Because if the stock drops below the strike price, you don't exercise the option. You say, why do I need that? What am I trying to do? I'm going to try to create a replicating portfolio that has exactly the same cash flows as the call. So here's what I do. I go back to where the stock price is 70. I know I need to borrow some money. Let's call it B. I know this is not an algebra class, but let's act like it is. So we don't know what the B is. Let's call it B. We need to buy delta shares of stock, which we don't know. So we don't know how much we need to borrow and how many shares we need to buy. But we do know this. If the stock goes to 100 times delta, which is the shares I bought, minus the borrowing with interest, I'm using 11% interest rate, has to be equal to 60. Do you see why it has to be equal to 60? It has to have the same cash flows as the call. So my replicating portfolio of the borrowing and the shares has to have a cash flow of 60 if the stock goes to 100. If the stock goes to 50, 50 times delta minus 1.11 times B, the borrowing paid back with interest, has to be equal to 10. I know it's been a long time back. But remember when you did simultaneous equations? Was that what, 7th grade, 8th grade? You have 2 equations and 2 unknowns. Sooner or later, there should be no unknowns, right? You just have to move things around. In this case, if I take the 2 equations and solve, this is what I get as my delta and B. Delta is equal to 1, B is equal to 36.04. You say, what does that even mean? If I go out and borrow $36.04 when the stock price hits 70 and buy 1 share of stock, that position will be worth 60 if the stock goes to 100 and 10 if the stock goes to 50, right? Because that's how I solve for it. Since those are exactly the cash flows I have on the call, that position has to sell for the same price as the call. And if you think about what it will cost me to create that position, I have to go buy 1 share of stock at 70. $36.04 comes from borrowing. So the amount I have to come up with as the investor in this portfolio is $33.96. So if I pay $33.96 when the stock price goes to 70, I can create a replicating portfolio that has the exact same cash flows as a call option. Guess what? The call has to trade at exactly that price to prevent arbitrage. So is everybody clear on what the process is? You start at the expiration date, you go back one period, and you start doing this algebra. You solve for delta and B. In fact, if the stock goes to 35, I do the same thing. 50 times delta minus 1.11B has to be equal to 10. 25 times delta minus 1.11B has to be equal to 0. Solving for that, here's what I get. If I go out and borrow $9.01 and buy 0.4 shares of stock, I have exactly the same cash flows as the option. That position cost me $4.99. That becomes the value of the call option if the stock goes to 35. So what you actually have to do is work one step back, because once I do this, I now have the values of the call. Stock goes to 70. Of the value of the call, if the stock goes to 35, it's an out of the money option. I can now go back to time equal to 0 and set up the equations again, where now I'm solving for 33.96 and 4.99, and that's why it's an iterative process where you got to work from the last stage one step at a time. But at the end of the process, I have a value for the call option of $19.42, higher than the $10 you would get from exercising, but that's the option premium. So binomial models, I can work backwards. Now do you see why I had to make it a binomial model? What if I made it a trinomial model? And what would I have? I'd have 3 equations and 2 unknowns. You know how dangerous that is to have 3 equations and 2 unknowns? You're in uncharted territory. That's why we have to make it binomial. There are only 2 unknowns. How much are you going to borrow? How many shares of underlying stock? It kind of restricts you. But that's the end game, is to create that replicating portfolio. Joseph.
With this model, though, doesn't it mean that you have the stock prices, or you would know?
You have the whole tree. So basically this is, so the question is, how would I do this for an actual stock is a different question. If you have the binomial tree for the underlying asset, it doesn't even have to be a stock, then you can see how the binomial tree can be used to derive it. It's really a vehicle for bringing home how replication works, because you can actually see it at each stage what you're doing. And we're going to talk about how to make this practical, because it's not just getting the prices, it's how this tree will look for an actual company if you try to draw it and you have a 3-month option. Yes, Nick?
Will it always be the risk-free rate, or are we going to use...
You always use the risk-free rate. You know why? Because if I bought the replicating portfolio and I sold the call option, I have a riskless position. That's the rationale for using the risk-free rate, is arbitrage is riskless, and that's effectively what you're pricing in here. And that's why it's always the risk-free rate that comes into play. Now let's take Joseph's point about this process. Let's say I gave you a 3-month call option in IBM, and you decide to draw a binomial tree for IBM, right? You've got to do it for the underlying stock. First, to have any chance of your price of having a binomial tree, your time periods have to be really short, right? You can't make it a day, because at the end of one day, think of all the possible prices IBM can be. So you got to make it, let's say, 1 second. So what are you going to do? You're going to take 3 months and you're going to break them into 1 second time intervals. How many seconds are there in 3 months? It's a rhetorical question. Don't try to answer. If you know the answer, don't tell me. I'll be impressed, but no, I still don't care. But imagine sitting there with a really, really sharp pencil, a really big paper, and you're starting to draw tiny little branches. Act like you're doing it. You're one of those meticulous people, tiny branches. Hundreds and thousands of branches. And you're able to actually write prices at each branch. Ready? You've drawn the entire binomial tree for 3 months now. Take a look at that paper that you've drawn this on. Okay? Then turn the paper on its side. Know what it looks like? It looks like a pine tree without... So basically it looks like this, right? Smooth out the outside of the pine tree. What's it starting to look like? You start to look like a normal distribution. As time gets smaller, if price changes also get smaller, and that's a critical assumption, because we're assuming that if you make time 1 second, the price change is also going to get small. The limiting distribution for the binomial is the normal distribution. You see how we're trying to avoid the problem of having prices? Because if you replace the binomial with the what's the great thing about the normal distribution? It can be characterized with only two numbers, right? The expected value and the standard deviation. So we're replacing estimating the entire tree. And guess what? The Black-Scholes is the limiting case for the binomial. So the Black-Scholes is not a different model. It's really the binomial model if price changes become small as time becomes small. That's called a continuous price distribution. Is that a reasonable assumption? It's convenient, obviously, because it allows us to go to the normal. Let me ask you a different question. Can the price of a stock jump in the next second? Sure. IBM reports earnings, the price jumps. It is not a realistic model, but it's a very convenient model because it allows us to use the normal distribution. In fact, if you allow for jumps in short time periods as time gets smaller, the limiting distribution for the binomial is some kind of a Poisson, I know it's been a long time, but Poisson distribution, the way usually taught in statistics, is they used to use bank tellers. Nobody's ever using a bank teller anymore. Make it an ATM if you need to. And you're the 11th person in line. And the question usually is, if the bank teller takes 3 minutes with this jump variable where some customer can take 15 and some can take 1, how much time will you have to wait before you get to the front? That's called a Poisson distribution. And in fact, there are option pricing models that use jump process distributions. Bob Merton, who won a Nobel Prize, has one of these. But they've never really caught on like the Black-Scholes has, because the Black-Scholes, in spite of the fact that it makes a more unrealistic assumption about continuous prices, is so much easier to work with. But you can already see the biases you're going to get from the Black-Scholes, which is in a normal distribution, price changes are small. The way your stock gets from 35 to 55, it goes 35, 35.05, 35.1, 35.15. So it's going to take you a lot of work to get from 35 to 55. You say, who cares? D part of the money options are going to be underpriced in the Black-Scholes model. Do you see why? Because if you're D part of the money, getting your option in the money is going to take an incredible amount of work in the Black-Scholes. The way this shows up is if you're one of those options people who love to use Greek letters to capture everything they do. They talk about volatility smiles. You know what that is? Basically, if you take options on a stock and you take D part of the money options and you back out the implied volatility, and you take at the money options and you back out the implied volatility, what you will find is the D part of the money options look like they're building in a higher volatility, when in fact what you're capturing is the limitation of the Black-Scholes, assuming that you have continuous price distributions. So that's basically the Black-Scholes. It's not a different model. It's a binomial that as time goes to 0, the price changes become smaller. So the value of the call option that Black and Scholes came up with in 1970, when they broke the code with this replicating portfolio. Okay? They didn't use a binomial model. They actually developed it with just basic math. They worked out the model. The original Black-Scholes, the value of a call option is a function of 5 variables. How many variables did we say affects the value? In fact, a few pages ago I listed out the variables. 6. So keep your eye on what I'm missing, because there is a story behind why it's missing. The value of an option is a function of the value of the underlying asset S, the strike price K, the number of years left on the option T, the riskless interest rate R, that should be a sigma squared the variance. So S, K, R, T, and sigma. What's missing? Which of the 6 variables? Dividends. So what happened here? There's a story that Fisher Black and Myron Scholes, while they were writing this paper on options, got stuck. They got an equation that nobody in finance had ever seen before. It required tools that nobody in finance had ever used before. Tools from stochastic calculus. In finance, calculus. And the legend is that a physics PhD student at the University of Chicago was wandering through the floor of the finance department at the business school, don't ask me why, wandered into their office, probably trying to commit a robbery or something, stopped at their desk, saw the equation, and actually wrote out the solution. He said, we see this in first year physics all the time. It's called Ito's lemma. We'd never heard of Ito. We didn't know he had a lemma. But this is something that first level physics students had to deal with. So the Nobel Prize should actually have gone to Fisher, Black, Meyer, and Scholes, and an unknown student in the physics department who wrote out the solution. But they ran into so many complications with that equation that they decided to take dividends out of it. This is one of the great things in economics. If something is really bugging you, it's getting in the way, just remove it. Assume a world without taxes. Okay, no default risk, even better. No agency cost. Oh my God, you know, you're on. So they removed it. In fact, the original Black-Scholes was designed to value what are called dividend protected options. And what the heck are those? Remember the Con Ed example I gave you, which is 2 weeks from now you're going to get a dividend of $1, it's going to drop your price by $1. And why were you upset as a call option holder? It's your strike price was fixed and the stock price was dropping by $1. So if you had a dividend protected option, you know what I'd do? I'd adjust the strike price. It's tough to adjust the stock price because it's an observed price. But the day the dividend gets paid, the dollar, I'd take, so if your strike price was 20, I'd make it 19. You know how many dividend protected options I've seen out there? None that I know of. But the original Black-Scholes was designed for dividend protected options. So one of the things we have to talk about is how do we bring those dividends in? We'll get there. But in the original Black-Scholes, this is what their end model looked like. The value of a call is the stock price today, not the expected stock price, not the future stock price, the stock price today, times n of d1 minus ke minus rt n of d2. I tell people, Black-Scholes model forces you to use all those virgin buttons on your calculator. You know what I'm talking about? You've never touched them. They're brand new. That small ln, the exponential button. No, these are things you never touch. There's that PV button, I know it's completely worn out, but everything else you've never even got to. But the replicating portfolio is actually embedded in there. First, let's look at n of d1 and n of d2, what they are. What did we replace the binomial model with? A normal distribution, right? You know what n of d1 and n of d2 are? They're areas under the distribution. The reason I emphasize that is in most statistics textbooks there's a normal distribution table at the end, but they tell you the height of the distribution. So it'll be d1 n of d. This is called a cumulative normal distribution. And it looks, in fact, I've reproduced the entire cumulative normal distribution here. It gives you a number between 0 and 1. And if you think about it, that's what probabilities also are specified, between 0 and 1. The way I think about n of d1 and n of d2 is I think of them as probabilities. In fact, n of d2 in option pricing language has a very specific measure. It is called the risk neutral probability that your option will be in the money. Let me give you an example. You plug in d2 and you get n of d2 of 0.63. You say, what does that mean? If you trust your option pricing model, there's a 63% chance that S will be greater than K and your option will be in the money by the time the expiration date comes. If n of d2 is 0.99, there's a 99% chance your option will be in the money. We'll actually use that property later on to kind of extract that information about real options that we're going to talk about. But that's what n of d1 and n of d2 are. They're like probabilities that factor in whether your option will be in the money. But here's actually the best part about the Black-Scholes, and the part that we usually miss when you plug numbers into a calculator and pull out a value. Remember we talked about replicating portfolios? When I did in the binomial, what are the two things I had to answer? How much are you going to borrow? How many shares of the underlying stock are you going to buy, right? That is actually embedded in the Black-Scholes. See this n of d1? That actually is the delta of your portfolio. That's the number of shares of the underlying asset you need to buy. So if n of d1 is 0.78, I'm saying you have to buy 0.78 shares of the underlying stock to replicate the call. You're saying, what's KE minus RT? What's E minus RT? Some big fancy thing, exponential, man. E minus RT is a present value factor. That's what you're saying. That's never the way we compute present value. You take 1 plus r raised to the power t. In continuous time, that's actually a present value factor. You're saying, why is it there? The original Black-Scholes was designed to value what are called European options. The most unfortunate choice of term because it suggests there's something geographical about it. But what separates European options from American options?
Exercise before.
European options can be exercised only on the expiration date, right? Now do you see why I have a present value factor? K is my strike price. But since this is a European option, when do I have to pay K? 2 years from now, 5 years from now, I have to take the present value of K. That's what KE minus RT is. It's the present value of the strike price. But I don't have to pay it unless the option is in the money. KE minus RT times N of D2 is how much I have to borrow. The replicating portfolio is embedded in the Black-Scholes. It's just not as direct as it was in the binomial. It's just lurking in the background. And every Greek alphabet in the option trader's lingo has something to do with the replicating portfolio. The option delta is what? The number of shares of the underlying stock you need to buy to replicate the call option. What's the option theta? You start with a 3-month option. What happens to it tomorrow? It becomes a 2-month and 29-day option. The day after it becomes a 2. As time changes, the replicating portfolio will change. An option theta measures how your delta changes as your time to expiration changes. What's an option gamma? It's a change in the delta as what changes? As the stock price changes. So the stock price jumps tomorrow, you have to redo the replicating portfolio. An option vega measures how the delta changes as the standard deviation changes. You say, who cares about all this stuff? If your job is to hedge an option position, what do you have to do? You have to keep updating the replicating portfolio every day, right? That's why we care about the replicating portfolio. It's not a fixed number that you just do and forget about it. If your job is hedging a position, you have to track this replicating portfolio as time changes, as stock price changes, as standard deviation changes, because that's how you stay hedged. So that's a very quick kind of review of option pricing. Let me do one final thing and then we can jump into looking at real options. Remember I said one of the flaws in the original Black-Scholes was there is no dividend? And that's a problem because many of the option pricing models we have to use will have something like a dividend affecting the underlying asset. So over the last 30 years, people have tried different ways of bringing dividends into the Black-Scholes model. This is the one that I prefer. There are other adjustments. Here's what I'm going to do. This works if you're willing to make an assumption that your dividend yield on the underlying asset remains constant across the life of the option. If you're willing to make that assumption, here's what your Black-Scholes model will look like. So let's suppose you're going to have a 2% dividend yield and you have a 3-year option. What happens to your stock price when the dividend gets paid? It's going to drop by roughly 2%, right? And it's going to do it for the next 3 years. So the first adjustment I make is instead of using the stock price today, I take the stock price today and I take out the dividend effect for the next 3 years. It looks like a present value effect, but basically I'm just taking out the dividends. I'm saying, look, over the next 3 years, I'm going to lose about 6% of my stock, so I'm going to knock down the stock price by about 6%. So the first thing that happens is you end up with a lower S times E minus, so basically that's the first adjustment. Second, if you think about the replicating portfolio, what did you do? You went out and bought the underlying stock, right? Now you're getting a dividend on that stock. You borrowed money on which you paid an interest rate. In the original model, when you paid the interest rate, you had nothing to offset it against. But now that you're getting a dividend on the stock, you're going to use the dividend to pay. It's a carrying cost. In futures and forwards, we call it a carry. So basically, the second thing that changes is your carrying cost becomes smaller. That's it. If you make those two adjustments, you now have a dividend protect. You have a Black-Scholes model adjusted to value a dividend-paying stock. This is the model we're going to use anytime there's a dividend yield in your real option model. This is the model we're going to draw on. So here's what we're going to do. Okay? One final point. If you open up a lot of real options books, one of the problems with real options books is they're written by true believers. Okay? In fact, when I read these books, I'm reminded of what Charlie Munger once said. He said, if the only tool you have is a hammer, after a while everything starts to look like a nail. And that's the problem with real options purists. They're so caught up in how neat this stuff is and how great this tool is that after a while they see real options everywhere. And if you read many real options books, one of the things they're absolutely categorical on is that you should never use the Black-Scholes to value a real option. They do have a point, and here's the reason. What kind of options is the Black-Scholes designed to value? Options which are European options, which never get exercised before expiration. You think, so what? If I call a patent an option, I have 18 years to exercise that option, right? But I never want to wait till the very last day of the 18th year, the 20th year to exercise the option, because then what's the point? In fact, the essence of real options is you want to exercise early. So the point is, you can't use the Black-Scholes. It's a European option pricing model. You have to use the binomial. And here's where Joseph's point comes in. You want to use a binomial? Be my guest. But then you're going to be sitting and drawing these little binomial trees for the rest of eternity, which strikes me as incredibly tedious and perhaps impossible. And here's another thing. If you can draw a binomial tree, I don't think you even need option pricing to value an option, and here's why. The binomial tree, you set prices, right? If you add the probabilities to each branch, what do you end up with? You end up with a decision tree. And if you remember probability and statistics, if you have a decision tree, you can actually take the expected value across time of a decision tree, and it's actually been shown that if you draw a full decision tree with probabilities and you get the expected value, you get exactly the same number you'd have got using a full-fledged option pricing model. So why bring out the blunderbuss when a BB gun will do, right? You don't have to bring out option technology if you can use probabilities and expected values. So what I'm trying to say is, I will use the Black-Scholes on my real options, and I know that it's for a European option, that I'm probably understating the value of this real option, but I'm okay with it. Because when I look at drawing an entire decision tree, if I can do that, I don't need options in the first place. I wouldn't even be doing this section if I had a full decision tree. There are times when I actually do decision trees, especially if I'm valuing a small biotechnology company with a single drug working its way through the pipeline, and you can see why, right? It's all probabilities and statistics, 3 stages, approval processes. This is actually a valuation I did of a diabetes drug. I made up the drug, I kind of made up the numbers, but kind of to show the process by which you would do the decision tree. But what I'm trying to say is, don't be a purist in this. You have to be pragmatic. If you're a purist, you will never ever use real options in practice. There are too many things that will trouble you. You've got to be willing to make compromises on basic option pricing requirements to actually get a number. And you have to be okay with the fact that you're going to have a much bigger range around that number. So here's the bottom line. Option pricing works best when you can replicate and do arbitrage. In fact, you start out, when is there an option? Make sure there is an option. Is there exclusivity? Make it pass the test. And if you're trying to use an option pricing model, the closer you can get to replication and arbitrage, the better off you are in terms of using an option pricing model. So what I'm going to do is take you through a series of real options. At the end of each one, I'm going to stop and ask these 3 questions. Was there an option here? Does that option have exclusivity? Can I use an option pricing model? And if you ask these 3 questions, here's what you're going to see. For every 100 real options people talk about 10 have economic value, about 3 can be valued using an option pricing model. And that's where it belongs, in those 3 companies, not in the rest of the 97. So let's start with options in investment analysis. It's a section that many of you in my corporate finance class saw at the end of the capital budgeting section. And there you saw just the big picture, the framework. So I'm going to build on that framework. So very quickly reviewing, in traditional capital budgeting, you take the initial investment, you take the present value of the cash flows, you net them out, you come up with the net present value. If the net present value is greater than 0, you accept the project. If it's less than 0, you reject the project. Nice and clean. However, that decision can change if there are options embedded in the investment. And in many investments there will be. The first is the option to delay, which is you can have an investment that is bad today but could be good in the future, right? That's the non-viable technology example. The second is the option to expand. That's a Marriott example where you took a bad investment because it gave you the rights to a much bigger market or a much bigger product. And the third is an option that we don't talk about much because it sounds like we're admitting defeat even before we begin, which is the option to abandon. What is that? Well, you take a 25-year project, 2 years into the project, you might decide that this project is not going to work out. If there's a way you can walk away from a project Even if it costs you money, it might cost you less money to walk away from the project than to stay in it. That's the option to abandon. So what we're going to do is actually value each of these options. And if you think about it, life is a collection of options, right? The job offer you're juggling of should I take 200,000 to go to Goldman or 80,000 to go to, I don't know, some startup. You're comparing basically different options, and those options. Or if you make it even more personal, my son is getting married in June. He's using up his option to delay. Right? Of course, I hope he doesn't use the option to expand after he gets married, because that's the equivalent of having affairs. An option to abandon, which would be divorce. But life is collection. I mean, basically, there are options all around us, and we have to think about the option. You don't have to put numbers on this, and you're getting married. So let me work out the option to abandon's value. Okay, too high, you know. Let me do this anyway. So you might do it in your mind, but don't put it down on paper. That could be, that could be deadly for you. But each of these is an option, and the value of this option can sometimes make a bad investment a good one. So let's start with the option to delay. Here's the setup, right? When you have the exclusive rights to a project, you can do the net present value today, but all that net present value is telling you is whether this project is a good project today. And even if you decide the net present value is negative, it doesn't mean that the rights to this project are worth nothing, because this project, if you have the exclusive rights, could go from being a negative net present value project to a positive net present value project. Remember what I promised you? Every time I talk about an option, I'm going to go back to basics. I'm going to draw the payoff diagram. Here's what the payoff diagram looks like on the option to delay. You have the exclusive rights, which means you can take the investment at any time and invest that initial investment, right? You will do it only if the present value of the expected cash flows exceed the initial investment. Right now that's not the case, but it could happen 2 years from now, 5 years from now. Of course, at the end of 5 or 10 years, you might decide there was a bad idea to begin with. You should never have paid for the rights, in which case you give up what you paid for the rights. That's a call option, right? What's the underlying asset? The project that comes out of that right, the commercial product you'll develop. What's the life of the option? However many years you have the exclusive rights for. What's a variance in the underlying asset? It's whatever causes the present value of the cash flows on that commercial product to vary across time. Yep.
Could you look at it as options of starting, or a collection of starting and delaying based on whether it has a present value at each successive time?
You could do. There are bunches of options, especially with mining companies. The big issue: should we start now? Should we start later? There are options embedded all over the place, but it's a variant of this option. Right?
So you don't do it. It seems like it's until you start.
I'll tell you where it shows up. Timber it's a big deal as to when you harvest timber, because obviously the longer you wait, the more valuable the timber becomes. There's an optimal timing as to when you do it, because waiting doesn't always make sense. So what we're going to do is introduce a cost of delay. Because if I don't introduce a cost of delay, you know what you're going to do? You're going to wait and wait and wait and wait and wait, because the time premium is there. So I have to give something on the other side saying, if you don't do it, it's a viable project, here's what you're losing. So that's going to be critical in all these options delays, putting that prod on the other side, saying, now that it's viable, this is what you lose by not doing it. Okay?
What if you start the project though, and then you at some point into the project before it has a positive NPV, you say we're going to delay this again?
That's
your NPV could be low.
it's not. You're not delaying the original project. You're delaying the expansion. So it's not the original project that you have the option to delay. It's a second project. So you've got to separate the second project. You have the option to delay that expansion on that project. Same technology kicks in. Okay? So let's take this and apply this, and I'm going to use this in a couple of places to value things that we run into in valuation. Okay? If you think about a patent, here's what makes patents like options. First is, in a country which enforces patent law, so let's be very clear that that's the only case where this can even be used. If nobody's enforcing patent law, there's no optionality. Right? When you get a patent, you get the exclusive rights to develop that patent into a commercial product. You get a right, not an obligation, so you don't have to develop it. So you can choose to develop it or not. So let's add some technology to it. let's assume that developing this technology will cost you I, billion, 10 billion, 15 billion, and that the expected value from developing the technology is V. That's you do cash flows, you do the present value. If V is greater than I, you will develop it and keep the difference. If V is less than I, you will sit on the patent and hope that it gets viable. That looks a lot like S and K in a call option, right? In fact, if I draw the payoff diagram in a patent, here's what it looks like. The cost of developing the patent into a commercial product becomes the equivalent of the strike price, right? And that could be a big number. If you're a pharmaceutical company, developing a patent into a commercial product might be billions of dollars. You will do it only if the present value of the cash flows from developing the patent exceeds that cost. And of course, if you never do it, what you will lose is whatever it cost you to get the patent in the first place, which could either be what you paid to buy the patent, or if you did R&D, it's what you spent to get the patent. It's a very different framework for thinking about R&D. R&D now becomes the price you pay to acquire options. Some of those options are going to be worthless, some could be worth a lot, and the option framework provides the cash flows. Yes, sir?
Is the negative NPV pretty like semi-arbitrary for this, or like with R&D for patents?
At a point in time, it is a number. It's negative net present value. It's not going to show up in this graph because it's going to be what happens over time.
So if we're showing up with the slope of that negative NPV thing, possibly be negative, not zero?
I'm sorry, it won't show up in this graph because basically what will happen is what you're capturing in the present value of the cash flows is a distribution, right?
Okay.
So right now you have an expected value. It's less than, so right now this is a non-viable option. It's not even debatable.
Okay.
But things can change. So next year when you redo the present value of the cash flows, you could get a much higher number. It's across time that you get the variance, not across, today. So let's say you decide to put this into practice. I'm Merck, I hire you. Say, look, I'm interested in this option pricing technology to value patents. Let's see how we get the inputs. For the value of the underlying asset, so let's assume that you have a patent for a drug. For drug to treat a disease, type 1 diabetes. I read in the New York Times, it's starting to climb among young kids. So you've come up with a drug. So to get the process started, I'm asking you what the present value, the expected cash flows would be if you develop the drug today. Okay, so that would mean looking at the potential number of people who have type 1 diabetes, how good this drug is relative to the competition, working into the numbers, coming up with the expense. So it's going to look like a traditional capital budgeting exercise. Discount back at the cost of capital, you get a present value that's going to become the S in the model. Yeah.
And to be clear, this would be different if there was a chance we were a biotech startup and this would bankrupt us or something like that.
No, that's a different problem. When you do this, act like you have the rights to it, because in a sense, here's why. If you're worried about bankruptcy, it's because you have some leverage issues that are separate from this product. This is just what you would then charge if you sold the patent to somebody else. Don't let your troubles knock down the value, because then if you go to Pfizer and say, I'll sell it for $5 million because I am in trouble, you're underselling it, right? So this is actually basically value the patent as a product, and then when you want to value the company, then bring in all the other things that are worrying you about whether this company will make it. Right? So the present value cash flows today, and especially with new technologies, you know what the argument I get from managers when I ask them to do this is, it's too uncertain. And I say, good, that's going to help you. It goes to the same point we made about young startups, which is make your best estimates. I'm not asking you to be perfect. I'm saying given what you know today, not what you will know in 3 years, what are the expected cash flows? That becomes yes. Then I ask you, what's the variance in that value? Now you have trouble, right? Because normally when you learn to look up the standard deviation for an option, you go look it up on Bloomberg, because it's a traded stock. But this is a drug and you have a present value came from your cash flows. There are a couple of ways you can come up with a variance. One is the long way, for those of you who are interested, which is to do a Monte Carlo simulation. Remember, we came up with a distribution and a variance, used that as the variance. That requires a lot of work, right? You have to understand the market, you have to put in distributions. Here's the other, it's cheating, but might as well do it. It's a biotechnology company. I want a variance in your value. I'm going to cheat, and here's how I'm going to cheat. I'm going to take publicly traded young biotechnology companies. I'm going to look up the standard deviation in their stock prices and make a leap of faith that that standard deviation is coming from standard deviations in the values of the projects they take, and use that. I know it's cheating, but think of how much time you save. That becomes a sigma in the model. For the exercise price in the option, I have to come up with the cost of actually developing this patent. Not just building a factory, but the entire cost, sales force, the additional infrastructure you have to bring in. The option expires when my patent expires. We'll talk about what the Pfizers and the Mercks do, because what do they try to do? And is Jeremy here today? Oh, there's Jeremy. What do they try to do, Jeremy?
They try to extend the patent life.
They try to extend the option life. And who can blame them, right? Because the longer you make the option, the more valuable. In fact, if you know that a 20-year option is going to become a 24-year option because you have the best legal team on the ground, think of how much more value you've added to your option, right? And here's where I have to bring in the other side of the equation. If I don't have a cost of delaying, no pharmaceutical company or biotechnology company will ever develop a patent. Because what they will do is, because it's an option, they'll wait and wait and wait, which makes absolutely no sense, because you're losing what? Every year you wait, you're losing 1 year of protection from competition, right? So here's what I'm going to do. I'm going to introduce what I call a cost of delay, which is once a drug becomes viable, I'm going to say if you don't develop it, you lose 1 year of protection, which I think is reasonable. So if you have 15 years left on the drug, it's like giving up 1/15 of your protection. And I'm going to introduce it as a cost of delay. Saying, what does it even mean? I'm going to treat it like a dividend. You see why it's like a dividend? What does a dividend do? It knocks off the value of the underlying asset. It's going to push in the direction of making you exercise, especially as you get to 9 years, 8 years, 7 years. If it becomes viable, you have too much to lose, that cost of delay will overwhelm the time premium of the option and you will exercise. Which is good news for you if you have diabetes 1 or MS, because that's what brings the drug onto the market. So let me try this. It's actually very difficult to get the data to do this from the outside, because this is for individual drugs. So this example is about 20 years old, because I was able to get all of the data I needed. It's a drug called Avonex. That's actually now, so I'll give you the rest of the story. I did this valuation at the time. Biogen had just got the patent on Avonex. So it was ready to be commercially developed, and Biogen was deciding whether they should develop the drug. So that's key. They've not developed it, it's still an option. So I decided to do an option valuation of Avonex. What's the first step? Is to come up with the present value of the cash flows if they develop Avonex today, which is a drug to treat MS. And if you've ever seen how pharmaceutical companies estimate cash flows, it's an extremely morbid exercise. Because here's what they do. They have the number of people who have MS, which they know pretty well. The number of those people, or the percentage of those people who will go to a doctor, which is not 100%. The percent of those people who go to a doctor actually get the right diagnosis, which is not 100%. The percent of people who get the right diagnosis who will start on medication, which is not 100%. And then the percent of those people who will get the best drug, which in this case, Biogen might be, and they work hard on it. So it's like doing any other analysis. You just have to work through all these numbers. You come up with revenues and cash flows. And based on and this is what allowed me to do this, as I was able to get my hands on one of these internal number crunching exercises. And according to Biogen, the present value of the cash flows from introducing the drug today was about $3,422. So file that away. That is the present value if they introduce the drug today. The cost of developing the drug for commercial use was huge, because Biogen had never produced a commercial drug on their own. They had licensed drugs out, but they were planning to do this on their own. Was $2.875 billion. Let me pause right there. The present value of the cash flows is $3.422 billion. The cost of developing the drug is $2.875 billion. If I ask you to do a net present value of this investment, it's just going to be the difference between those two numbers. It's $547 million. So file that away. If this were a capital budgeting exercise as a DCF valuation, the value of this drug is $547 million. But now let's introduce the optionality. There's 17 years left on the patent. That becomes the life of the option. The riskless rate then, the T-bond rate then, was about 6.7%. And for the variance, I cheated. I used the average stock price variance of young biotechnology companies, 0.224. Is this a viable drug right now? S is greater than K. It is viable. So I introduced the cost of delay. If you don't do this right now, you're going to lose one of your remaining 17 years. That becomes a cost of delay. You see what that cost of delay is going to be next year? It's going to be 1/16th, 1/15th, 1/14th. The cost of delay is going to climb. It's what's going to kind of prod you into developing. I plug the numbers in D1, D2, N of D1, N of D2. The value that I get for this drug as a as an option is $907 million. Now do you see why people like real options? What is the DCF value of this drug? 547 million. The optionality just added 360 million to it. But here's where the rest of the story kicks in. If you believe the numbers, not only am I giving a value for Avonex to Biogen, what am I telling them about developing the drug? Should they or shouldn't they? They shouldn't develop the drug yet, because the minute they develop it, it becomes a traditional cash flow. You're replacing 907 with 547. I'm saying wait. In fact, if you believe my numbers, they shouldn't develop the drug for about 8 years. What I did was I kept redoing the analysis, changing the cost to delay, and the cost to delay kept climbing and climbing. There's a tipping point. They probably wait about 8 or 9 years. They actually developed the drug almost right away, which led to them soul searching. What is, I mean, something in the numbers must be wrong, right? So take a look at the numbers. What do you think is the number that I've screwed up on? What's my cost to delay? 1/17. What am I assuming? That for the next 17 years, they're the, what does the patent give you? The right to develop the only drug for MS? No, the right to develop your drug for MS, right? What if I told you that there were 4 other pharmaceutical companies working on their own drugs for MS, and the next one is only 6 years out? I mean, you know that it's coming out in about 6 years. What should the cost of delay be? 1/6. And if you put no 1/6, and with what I've discovered is in a competitive pharmaceutical sector, the optionality starts to disappear very quickly. Because you can't afford to wait. It's not 17 years of protection. It's, you know when you're going to wait? If you're a monopoly pharmaceutical company, and you have the ulcer drug, or the anxiety drug that dominates the market, you're not going to come up with a new drug for a long time, because there is no, it's the optionality. You're going to wait and wait and wait until it's just right before you jump in. So I guess it's good news that there's competition, because it forces early exercise, which effectively means these drugs get to the market much sooner.
I have a question. So
Yep.
for like a small molecule compound,
Right.
they would have 5 years within the patent term of FDA regulatory exclusivity. The patent term would extend after that, but at that point, like a Teva or a Mylan could come in and invalidate the patent.
That you have to build in an expected value into it, and it'll also mean that your optionality is strongest for those 5 years. It's the exclusivity issue, which is beyond 5 years, there might be a lesser option. You might have to do 2 separate options. One for the first 5 years and the other for beyond year 5, because you still have an option. It's not that you become level with everybody else, but I've kind of brought you down to a level where other people can start to compete with you. Right? It'll also show up in your margins and cash flows. When you do the expected value, remember those margins you charge reflect that you're the only game in town for the next 5 years, and then you start to see it. So you have lots of levers under your control, and you have to use them all to come up with the value of the option. Right? Yes?
Going back to the value of the cost of developing the drug.
Yeah.
You said that this company had never developed a drug before, and it always licensed it out to someone else. But isn't that kind of imposing
A cost, that's very likely. So it might be that selling the drug to a Pfizer that already has an infrastructure to sell the drug might give them a higher value than what they would face developing the drug.
Okay,
Yeah.
because earlier you said that you shouldn't impose the problem with
That's right. So in a sense, they decided, this was a decision they made. At some point in time, if to be a pharmaceutical company, you have to have drugs with your name attached to them, right? If you keep licensing everything, that's okay as a small, but at some point you have to establish yourself, and this was where they're going to draw the line. This was going to be their drug, right? Yes?
Last slide.
Yeah.
Can you explain again? This is a basic options question. Slide 31.
Oh, 31, yeah.
Like, why
All
is
I'm
that
keep,
the-
yeah, all I'm keeping, doing here is, if you look at, I'm keeping S and K fixed, right? Which is, actually what I'm doing is I'm redoing the S each year with less years. I'm redoing the K with whatever, what today's costs are. And I'm redoing the cost to delay. That's the biggest number that's changing, from 117, 116, 115. As the cost to delay rises and the time premium decreases, there's a point at which the cost to delay becomes higher than the time premium. That's year 8. When that happens, what will happen is the value of your option will be less than the net present value that you get for the project.
So anytime the option value is higher than the NPV
Yeah, that's basically it. Then you have a time premium, and that time premium means you shouldn't exercise right away. Last point. If you think about bringing this into valuing a company, it becomes a lot messier because a company is not just a patent, it's a collection of patents, right? In fact, it might have developed products on which it's getting revenues already, which I have to value as a stream of cash flows. It might have existing patents which I can value with option pricing, and it has an ongoing R&D department that's not done. It might create more patents, and all three layers have to be valued in order to value the company. If you want to use this approach instead of a discounted cash flow valuation, just remember you can't double count. What I mean by that is if I gave you Biogen to do a discounted cash flow valuation on in 1997, how would you have reflected the fact that Avonex was this really promising drug? What input would you have changed in your DCF model? You'd have used a much higher revenue growth rate and higher margins to capture that. If you do that, you can't add the 907 million on top of it. And I've seen people do this in equity research. They'll value a company using traditional models and say, oh, by the way, there's a real option. Let me add another billion on top. You can't do this. If you want to bring in this technology, you almost have to redo your analysis. Next session when we start off, that's what I'm going to do, is I'm going to value Biogen in three pieces. Its existing products, its patents, and the ongoing R&D. It's a different way of thinking about valuing biotechnology and natural resource companies in general. So next session we will apply the same approach to natural resource companies as well.
can increase because of like commodity prices through this. So it's not fixed price. So that's where like maybe the like falls open. And the whole like paper it reduces it outweighs the value of the so like in some respects you raise a valid point, but the technical answer is rigid all options. You want the time to